I can get through this pretty quickly because I've got some Thursday night plans. But today we're going to go through very briefly, because of all the weirdness going on in the financial system, the fractional reserve system, a really quick way to look at the banks and understand why my tweets might have been a little intense today, given that we've got Silvergate going on and we've got really it's Silvergate and then everybody that's surrounding them, Silicon Valley Bank as well. But I do want to talk through this because there is such a bizarreness in the way people report the banks. And I really think it has to do with the fact that the financials aren't the easiest thing in the world to really go through if you're not familiar with it, for lack of a better way. Let me move some of this out of the way, though. Past performance, not indicative of future return. I will probably also talk about Ally Financial and Citizens Financial, just to show you like two different banks and the balance sheet so you can really compare and contrast. I have a short position in Ally Financial right now. I do not have a position in Citizens because right now, in general, I'm a little scared of the banking system. I think there will be some significant winners and losers because it's a real test. Like Silvergate winding down, given how much it was reserving in CET capital, as well as how much it was funding over deposits, was not normal. And that's why, if you guys, and I would love it if you can continue to help me grow my Twitter, since that's a new account, I can't even get Twitter Blue for a little bit. I think David's having a little bit of a problem getting into this. So let me just give him. Let me just do this really quick. Past performance is not indicative of future returns. And let's get into it a bit. Okay, so a lot of folks have talked about fractional reserve system, and you'll see a bunch of wonderful articles on it. But what does it look like in the financials? Like, what are you actually looking for to have any kind of sense for whether or not the bank that you're looking at or the financial company you're looking at has a real problem? Now, remember, the first thing to remember is that fractional reserve is, as much as people want to talk smack about it, what was there before was not better. It was significantly worse. Okay. And that is just a failure of some people to understand the history of finance. But, a fractional reserve system is a trade-off. What we're really talking about is that a bank makes money by lending out deposits. And so they are absolutely not holding your deposits as cash. Otherwise, they would make no money. And we would have zero liquidity in the marketplace, and then it would just be a complete problem. So let's talk about what causes a run on a bank. Okay, what causes a run on a bank is really the fact that they have they take in your assets and then they do something with it. They invest it. And that investment, you can actually start to cripple a bank both by having problems with the assets as well as having problems with people actually removing assets from the bank. It turns out, and this is very important for people to understand, that hold on one second, guys. Let me just turn this down. It turns out that when you are, okay, so customer deposits are held as a liability on the balance sheet. That's the biggest part of it. And that by far is going to be the most that you have on balance sheet as a liability. So in the case of Silvergate today, what happened was, as people were pulling liabilities out, all this other stuff becomes a problem. So you've got, going through this very quickly, on the asset side, you've got the liquid stuff, the stuff you can sell immediately. Given how liquid it is, it's not going to actually create any kind of problem when you go to sell it to try to give people back their money. That typically would be the stuff that's in CET Capital Ratio Tier 1. It's going to be essentially cash and cash equivalents. So it really has to be liquid. Then you've got the non-liquid stuff, and that's stuff you're lending out. Some of that stuff you can sell, and it will lose only a baby tiny amount of money on a given day. If you have to sell it in size, that's not true, okay? Then you've got the non-liquid stuff that can literally go beyond zero. The non-liquid stuff that can go beyond zero is toxic stuff. And these are the three kind of sets of assets that in particular can cause a bank or any financial institution a problem. On the liability side, you've got the deposits, which is the by and far large should always be the biggest part of any bank, okay, on the liability side, unless it's an investment bank and then there's a couple of other things, but really deposits on any commercial bank is going to be the biggest part of what's going on. Then you're going to have loans to the bank, and those are usually, for a commercial bank, they're not that big. For an investment bank, different story, depends on what exactly they're doing and what type of bank they are. And then there's everything else, and everything else is usually kind of small, again, unless it's a strange particular situation. Now, Silicon Valley Bank, a little bit of a different animal, because they also will have a sizable amount of loans to the bank. I'll do them at some point separately because I know that's going to start to be a big interest given what's happening now. But loans to a bank is like their liability side is going to look ever so slightly differently because so much of their assets is actually private equity based. Additionally, a lot of the stuff that they have is non-liquid stuff, so to speak. And it's going to be not eligible for tier one, which means that to the extent that deposits start to come out, they're going to have to sell some stuff. And it could get really nasty if they wait too long. Okay. So that's kind of the deal of what causes a run on banks. Most people think it's just because some asset goes bust. Nobody. You can also create a run on a bank. Like the fact that when people start to pull their deposits, it comes out really, really fast. Additionally, and this is a big problem, which is the second bullet point I have on this slide, if you run through all of your liquid stuff and your non-liquid stuff, where you might take a little baby mark, and you get to your non-liquid stuff that can go to something less than zero, that would be Credit Suisse, then you're going to have to sell it at a discount because people, number one, know that you got a problem. This is the same as like buying something out of bankruptcy, okay? Even though you might not be bankrupt yet. So if you sell through the liquid stuff and you sell through the non-liquid stuff and you go into the non-liquid stuff that can go to less than zero, which absolutely is a thing in finance, then that's when you got to start taking a mark. And the challenge of taking a mark is you're not just going to take the mark on your own, on the stuff that you had to sell. You may oftentimes, especially if you're a bank, by the way, but if you're even a non-bank, a neobank, or something that looks something like a bank, you're also going to have to take the mark. Your accountant and your auditor should make you take the mark on everything that looks like that thing you took the mark on. That's what makes it very scary. And that's what makes today a big fat pause for anyone that understands this conceptually from buying stuff. Now, I'm going to go through a couple of healthy and non-healthy examples just to help you. My healthy example is 100% going to be Citizens Financial Group because, and we'll go through why. Am I on the borderline? Because I'm not going to go through Silvergate. Silvergate's financials are actually way more complex for me to try to just explain this concept. But it wasn't complex necessarily. Honestly, I don't actually think they were trying to do anything wrong. I think they just underestimated customer deposits coming out so fast, yanking the living daylights out of everything they had on the non-liquid stuff. So that's really what happened with Silvergate, which I will go through again. But that is, so let's go through the two financials. Now, I want to explain why then, given a fractional reserve system, would anyone not just start hoarding cash the minute they had any kind of concerns? Well, unfortunately, in the third quarter and the fourth quarter, and then even at this last quarter, one of the things that everybody keeps saying is that the consumer is so strong. Like even I've said it, I'm guilty, but we talked about it in the last quarter and why I had some concerns. But everybody's like, hey, the consumer is the consumer is so pristine. They're not going to default on their debt. So it doesn't matter, and so what they would see is something like what Ally Financial presented. Okay. So what Ally Financial presented in their deck was this, which is you get higher margins on loans. This is because the rate itself is higher, and also a lot of people choose not to lend. Now let's break that down for a second. What do I mean by the rates are higher? I mean that because the overnight rate is increasing, you could look at the yield curve for the 5-year, et cetera, all the way down. Every single piece, the whole curve has shifted since last year upwards, no matter what you want to say about the shape of it. But because that yield is actually higher, then for any given tranche of person, of which Ally does actually a pretty decent job at telling you prime, super prime, subprime, et cetera. For every given tranche, you can make more dollars if you're lending that money out. Okay. Now, the other thing is other people aren't lending. Now, why aren't other people lending in the case of Ally Financial? Okay. Ally is primarily and mostly auto loans. I don't know why other people are suggesting otherwise, but they are mostly auto loans. It's clear as day. They don't make any arguments or suggestions that they are not. They're mostly auto loans, and they're a mix of new and used cars, and they're a mix of other things as well. We're going to get to that. But when others aren't lending, which is what's happening right now, to that part of the capital structure, then you can actually charge more for the loan. And the reason that a lot of the banks are not lending is because even though the consumer is solvent, they don't care. And that was said best by a couple of the different banks, as well as Citizens Financial, which was one of them, that was just like, listen, we're happy to high five other people as they're making money. But since we're a bank, we don't make anything extra for like making 15% versus 10%. If anything, taking on more risk really pisses off basically our investors, because all they're going to see is a higher return. They're going to be like, how did you do that? Exactly. What did you do? You got danger now? So a lot of them were just like, yeah, we're good. What we're going to do is with the loans we have, we're going to high grade them. We're going to decrease the amount of loans. We're going to hold more cash. And if we end up having to have our investors upset with that, but the bank stays solvent, we're just going to take that on the chin. It's fine. Okay. So that's why for especially companies that lend to a very specific segment of the population, or alternatively to a very particular type of asset, that's what's actually going on for them right now. So the bull argument is they make better net interest income, meaning like they lend out at a higher rate for the type of risk that they're seeing. The bear argument is literally all of this. Okay. This is the bear argument. This is why I keep shorting some of these companies, or every time somebody's like, well, May, the consumer's doing great. Why are you so like weird about this? And I'm like, because I honestly need to see more. The problem with the bear scenario is you have this concept of correlated default, meaning that no matter how you try to do the math, the auto loans in one location may default at the same time as an auto loan in another location. Similarly, you have correlated default across different types of assets, meaning that guy who's broke, who can't pay his automobile, also can't pay his mortgage. Okay. In the case of Ally, they do have really, it's all auto. So it's both auto insurance and auto. So you have correlated default. That's very bad. The second, and that's why someone like Citizens was like, yo, we're just going to wind down the book a little bit, just get a little more CET capital on hand. Okay. The second thing is underlying asset impairment. And this is part of the reason why, if you look at any of my videos for the last 2 quarters, or since like the 4th quarter, I did a little bit positive, and then I was like, whoa, my bad. I was not expecting used car prices to fall this precipitously. But one of the calculations for what actually constitutes the correct price of a loan is what happens when you repossess that. Remember, when you default on the loan of your home or your automobile, the bank becomes a very excited new owner of a home or an automobile. So if the price of that asset goes down, then necessarily that was not baked into how much they charged you for your interest rate. So underlying asset impairment affects what's called the hazard rate. Definitely is a bear argument for any area of finance where you have a depreciating asset, period. Okay. So that's real estate. It's anything that's asset backed. The third thing is risk offset gets really expensive. And this one, a lot of you guys are day traders, options traders, vol traders. You guys see that already. Volatility on single asset risk. Even if the VIX is going up and down, on single asset risk, you'll find that given the way that either the options is priced, or alternatively, given the way the curve, the smile actually is showing, hedging out your risk is painful. So risk offset is very expensive. And in some cases, you just flat out can't hedge it. And the last thing is there is a time component to many types of assets. And that time component of risk is also nasty. So for example, just because you were hedged on Tesla this week doesn't mean if you did it with options, that thing could expire and next week you're long again if you were short or whatever it is. Okay. Additionally, with any given loan, refi risk is a thing. So if you took out an ARM instead of a 5-year, or if this lender is taking out variable rate loans, like somebody just has a 3-year ARM or a 5-year ARM, and that bad boy rolls off and you've got interest rates increasing, and the guy you gave it to wasn't making a lot of money to begin with, that's a real risk. And refi risk, particularly as relates to default, is something we're going to have to watch very closely, because we're 3 years into COVID and rates have gone up a lot. So that's a real thing. And then, so that's on all loans that have a variable rate, also true of corporations. And then company funding has a time component, meaning the banks themselves sometimes fund themselves with debt. Now, who funded themselves with debt? Silvergate was really freaked out in the third quarter. And also in the first quarter, they already told you that they went ahead and tapped the window, talked to the Fed, were doing all these things to make sure they had enough cash money to actually pay people. They started removing deposits. So that aside from everything else that they did, which quite frankly, in fairness, this might be one of the most respectable wind downs I've seen in a while, because they did not try to do any funny business after telling the investors what was going on. That's part of the reason why I got a little nasty with Coinbase today, because I don't know exactly why they did that, and maybe I'll turn out incorrect in my assumption that they shouldn't have done that. But without more announcement on what they were saying, I do think it was a little nasty for them to just both two-way transaction cut them off like that. It's a little bit abnormal. Okay, I have a couple of things I just want to show you. And then, like I said, unfortunately, I do have a hard stop at 5:45 today. But okay, so this is an example of CFG. CFG is Citizens Financial Group. They were pushed so hard on the call as to why they're at 10% CET capital ratio. Why didn't they go lower? And they were like, listen, they truly were like, if anything, we're going to take the book down and continue to grow deposits. Number one, because growing deposits is our mandate as a bank. And number two, we don't trust this market. Okay, that's really as simple as it was. Gotta give them love for that. Okay, and they weren't the only ones that did it, but they were the quickest for me to just pull it off. Some of the other financials are a bit more complex on the financials, but I just want to show you very quickly on their balance sheet so you can do this work for yourself. Let me get to it. All right, if you look at it, what you're looking for and what you're trying to see is this right here: net loans and leases, 154. If you look at it from, even though they grew net loans and leases 22%. I know this is small as they come. Hopefully you guys are looking at this high def, but literally you can go to Citizens Financial and look at the assets and liabilities yourself. But 22% from last year, but they had 0% growth in that quarter over quarter, meaning they were like, after what they saw between September and December, they were like, no mas, we're going to start taking it down from here. And then you see deposits, though, continue to grow. So they had 1% deposit growth just quarter over quarter, 17% year over year. And that's what they were talking about. They were like, look, deposits, no problem. More lending, not so much. Okay. And so just to give you a sense for it, 180 in deposits, 154 in net loans and leases. Then there's a bunch of other stuff. Okay. Goodwill, and all that gets you to total assets. Just kind of get a sense for what it might look like for a bank that's trying to absolutely grow its reserve situation. Here is the CET capital portion. It's usually in financial metrics. You oftentimes have to look for it in where it's going to be put, because there is no standard place within the 10K or otherwise that you write CET capital ratio is this. But you can see they amped it up just a touch, not a big deal. But given that they've announced that was going to be their strategy and what they're going to do, I feel a lot better about it. For comparison, capital ratios are usually 8%. 6% of that has to be tier one, meaning it's like you better have cash or something that we all can easily identify. Have CFG, we'll get to that, PB. You better have cash, or you better have something that I know liquidates easily. So like some kind of 2-year or 2-month, 1-month treasury is fine, stuff like that. Okay, that's what we're talking about there in CET tier one capital, and they're fine within banking regulation, et cetera. And in fairness, so is Ally. Here's just for comparison, though, so you can see it. This is Ally's. They have 152 in deposits, 130, and then it's a little bit funky. So they've got 31 in securities, And then they've got these loans held for sale to 132. So between that, that's already above the deposits, right? So that's 31 plus 132, that's 160. That's why for some of you guys that were on my Instagram today, or sorry, on my Twitter today, and you were like, well, what do you think about the share buyback? Because I know they didn't want to do the share buyback. I was like, if they did the share buyback, then I would be flat out aggressively short, not just baby little bit short, because you cannot have this right at this minute and keep going, because these loans held for sale essentially are loans that you cannot get off balance sheet, or it's taking a little longer to get off balance sheet. And typically you would be able to get them off balance sheet, be no big deal. And what the loans held for sale really represent is the fact that you're growing revenue and you're making more loans and everything is fancy and awesome. But that's not what this is right now, because we know that the used auto market's secondary market has closed itself down. We know that from Upstart. We know that from other banks that people have screamed at me for on my YouTube channel. So that's kind of the thing. Do I think Allie is in a bad financial situation? No, they're what I call on the line. But then what's the valuation you deserve for being on the line? Okay, other places you might be able to see it is the cash flow statement. Again, like I said, it's not great. It's not great, but it's also not the worst. You see, number one, provision for credit losses are back up to 2020 during COVID times. That's a smart move. Okay. So it's always possible that if they can get through this and the markets can open back up and start buying the loans off of them, that actually they're over provisioned, but nonetheless. And then the other couple things, originations and purchases for loans held for sale relative to the proceeds from sales and repayments of loans. So that number, it's a little bit, it's more or less like every other quarter. Can't get mad at them for that. It's over here in investing activities where you also find some of these loans that are kind of working through the balance sheet. And you can kind of see it's not the worst, but there are some moments that are strange, like originations and repayments of finance receivables up a lot. But the net number on net cash used and provided for investing activities, that's the piece that gets a little bit like people that might be more sensitive, or let's say you own it. That's where people would get a little bit not so happy, let's call it. And that's why I'm saying they're a little bit on the line. Okay, now the CET capital ratio was down, not up on the quarter. So they did not reserve more capital. Even though many people on the call felt like they were well reserved relative to the book they had, to me, I would like you even more reserved, because unlike COVID, where you had a bunch of stimulus that was necessarily coming in, right now, that's just not the deal. And unfortunately, even though, and I encourage you to look at the financials yourself, even though there's actually a lot more prime and super prime loans on Allie's books than you would have, versus some other folks that are full of it, quite frankly. You know what I mean? They actually report their slices. I can't be mad at them for that. Nonetheless, they're on the line. They're like smacking the line really hard. And this, I think they reported maybe January. They report not necessarily the earliest, but they'll report in April, probably not May. And so we got to be so careful as far as Allie goes right this minute, because if we continue to have more deterioration, it's a problem. And hopefully that made some sense, because I know this is really complicated. We have a bunch of questions, and then David's here because David was the one that was like, May, can you do this? I think this could be really helpful. I love this. You guys are so nice posting all this stuff in the, okay, PB, let me ask this question so that David has a chance to catch his breath as well. CFG book, their derivative exposure, usually shows very clearly as derivative exposure. You just want to look. Usually it is going to be in the notes as far as that goes, but almost all the banks show very clearly derivative exposure. The other way you can look at it is they will show you, many of the banks will show you tier 1, tier 2, and tier 3 capital. That is even more true for the investment banks. And then loan syndication exposure, I know what you mean by that, but you will usually see line items for, here, let me try to show this a different way. It usually is on the balance sheet as well, and you kind of have to come at it. So if you look at the balance sheet in this massively small font that is in their presentation, which I wish was a lot larger. I don't know if I can get it any bigger than this because of my own weaknesses. Okay, so, all right, maybe not. All right, so if you look at it, And if you were to pull this up, guys, just take my word for it. Under assets, you will see that there is line item after line item on what those assets actually are. So it'll be like auto loans, mortgage loans, commercial mortgage loans, residential mortgage loans. A lot of the banks will absolutely give you line item by line item. And then you can think about the syndication exposure from that perspective. You can either think of it from the perspective of they're going to hold these and they're not going to sell these until syndication opens back up, or you can think of it as any number of ways, but that'll give you the approximate dollar value to what exactly it is within debt they're exposed to. Hopefully that helps. Hey, David.
Oh, hi, man. Yeah, it's tough to lose money banking, but they did it. I'm thinking,
Yeah, it's a run on the bank. Run on banks are really ugly.
well, we're in the Silicon Valley, and SIVB does 50%. That's 50 of the
Yeah.
startup. So, I mean, and private equity went to almost zero last year. So,
Yeah. You mean syndication it and
right.
yeah, deals. Yeah, there were very few deals done last year.
And if you're banking with them as a startup, I'm thinking you're doing your mortgage with them also.
Yeah, they do. I mean,
they've got $5 billion in long-term mortgages. That's a lot. They got what out of 6.27 market cap billion market cap, $5 billion in mortgages. That's a pretty high percentage. Anyway, and if you have to mark that to market, right? So interest rates have gone up, so that the value of that mortgage has gone down a lot.
Well, the mortgage actually isn't going to be the component that did it for them. It's really the private equity piece, because a lot of what they have and a lot of the ways they make money is through the warrants of those companies. And if nothing's going to happen, or alternatively that company is going bankrupt, they need to go ahead and take the mark as soon as possible so they can move past it. So the mortgages, maybe, definitely, I'm not going to deny that you're right on that. But the bigger problem for Silicon Valley right now is that the private equity market has stayed closed. And with rates where they're at, meaning that funding cost is high, and also with all the generalized uncertainty, both coming from geopolitics, which doesn't necessarily affect U.S. companies that are just doing their business in U.S., but what it does do specifically is make it very unclear precisely what is going to happen with the economy here or overseas. And that is really capping all private equity right now. There's just too much uncertainty.
Right. Okay. So from a revenue standpoint, I'm thinking when you have to maintain your capital levels, right? And if that mortgage is marked down,
yeah, but they don't have to, they won't. That is important. Don't get me wrong. Okay. But
yeah.
that's not like, they don't have to take that mark unless they're having issues with other stuff. I don't think
But
about that.
if I loan you $100 and it's now worth $80, I have to make up for that $20 somewhere.
Okay, so that's true, and it's true. That is true. The principal component of the loan is important, but it's only important if you sell it.
No, but you have to keep it.
You actually don't.
As far as regulators go, yeah, that's what got us in trouble in 2008. You
don't have to take them. You only have to start taking the marks if you have to start selling it, and you only have to start selling it if you start to either have people pull deposits, one, or two, if you have to take the mark because you're just out of liquidity somewhere else. You take an L.
I'm not talking about against income. I'm talking about capital.
I'm not talking about against income either. It just has to do with what happens to CET capital. It's a circular situation. That's why. So with Silicon Valley, I haven't reviewed it in a bit, but and they quite frankly are buffered a lot better than the other banks that also had issues today. But you don't actually. That's the crazy thing, and so like right now, you only have to take an asset impairment when you go to sell. But if you decide to hold that loan to term, you don't technically have to take the asset impairment. I don't know another way to say it. That's really what it is. But if you start to have a liquidity issue where you need to raise capital, so let me go back to this slide, just because it must be that this slide was less clear. Okay, this is your challenge, right? Sorry, not this slide. I think you might not have yet been on this slide, right? So if you have plenty of liquid, so the tier one capital is, I'm going to say it roughly as this, but technically there's stuff that's very liquid that would not be allowed for tier one capital. But unfortunately, if I say it any other way, you get this ridiculous definition from the SEC, or sorry, from the Fed, from the OCC, and from the SEC, because I think they collaborated on it. That just won't make any sense. And so, really, what we're talking about is the liquid stuff. If you've got plenty of the liquid stuff, which is essentially deposits at that point and cash that you kept on hand with it, and maybe like the most liquid of stuff that more or less can be liquidated overnight and not one person is going to have an issue with you, then you're fine. You don't have to take the mark. When you start to go to the non-liquid stuff, every time you sell it, everything that looks like that thing, you might have to, your accountant may make you take a mark on it. Okay. And especially if you're filing your year end or whatever it is, your accountant is probably going to be, your auditor accountant might have a very serious conversation with you on what it is. And so for a lot of companies right now where there's no consumer defaulting or anything like that, but they've sat there and been able to pretend like there's no mark, namely Upstart, which is why I keep going after Upstart, right? Because I don't understand the mark that they're taking, because they're not really clear on what marks they're taking, but Upstart is not a bank, so there is that. Then you don't have to take your mark, okay? However, this stuff, the non-liquid stuff that can go to below zero, that you are going to actually potentially have to take your mark on, depending on what it is. Mortgage rates are not going to be the truly non-liquid stuff that you have to reserve extra against. Like, that's going to be your true derivative instruments where that thing can actually go below what you put in it to begin with.
I'll promise you, the investors that were interested in buying their debt or their preferred, whatever they're floating today, saw the mortgages, and that affected the price.
Well, today they took a $1 billion hit. They took a $1 billion write down. So that's absolutely what's killing the stock, is that they took a $1 billion write down. We don't know if they have to take more. So,
but they floated money to pay for that.
Correct. So that's the reason they probably had to take the write down was probably because they ran through this liquid stuff and realized that the only way they were going to pay it was either to take the mark and get some money, or run through the liquid stuff, which they're not allowed to do. And so things that could force them to do that more often is customer deposits declining, which we're seeing across the entire banking system. Loans to the bank, meaning like they had a loan that was hanging out there from last year that needed to be rolled. But in order to get it rolled, they were going to actually take on a higher interest rate. So when they went to do the math, everything got nutty. Or something else, which was an actual L, happened. A bunch of the companies for which they were receiving something went bankrupt. And so they knew they had to take that L anyways. And all of those things together could absolutely force you to do something in the non-liquid stuff or the liquid stuff that goes to less than zero. And so that's kind of the weirdness of this kind of market situation, and why when you called me earlier, you were asking is it just Silicon Valley Bank that might have this nasty, or is it more than that? And I was like, look, in fairness, if I was at a bank right now and somebody was like, May, what's the potential damage? I would need time to be able to do that. Like, and I would be doing it across the fringes. That's why I've been looking at, well, thank you everyone that suggested that I look at Silvergate. I was not looking at before. And then obviously I went to all the banks that are associated with that, of which sometimes Ally, even though it doesn't have this crypto stuff, but it does have a brokerage or it does have a piece where you can kind of coordinate with another crypto exchange. So it does not have crypto exposure from what I saw that was meaningful or even relevant. But what it did have was a bunch of auto financials exposure, which is a problem because that's another asset class that's absolutely deteriorated in value. So they have not taken the mark, like you're saying, David. As relates to Coinbase, they're not a bank and they're not regulated, but it was very weird that they decided to cut off Silvergate. Hopefully that helps.
Got it. Why wouldn't they hedge shorting the bond market? I mean, their risk is interest rates going up.
They probably did hedge some of it, but they probably aren't hedging it like crazy. I'd have to look through. If you're talking about, are you talking about Silvergate, or are you talking about? I haven't had a chance to go through Silicon Valley's financials. I've been going through too many bank finance. There's like so much that's going, like there's so many banks to go through. Silicon Valley, I will take a look at. And in fairness, it's a dangerous one to go long or short, either way right this minute. I probably wouldn't touch it until there was time to really go through everything because
May it was at 200 and change last week, 267 yesterday.
yeah.
It traded down to 106 today. It's now at 84. So,
Yeah.
I mean, something is really wrong. It looks to me like.
Well, $1 billion mark's not a small mark. Like, I don't know that one for sure. And I'm not like I just have to go through the financials. Most of their exposure is private equity, though. I don't know if that answers your question. Let's see if there's any other any other questions before I have to run off here. Okay. Israel, thank you. Please do ask that question of Adam. Yeah, I don't think we have any more questions, so we may just kind of have to close it off here. You have any other questions, David? I can see you're kind of looking at a text on your phone. Is it something that you're seeing?
Yeah, I'm just looking. I'm looking for the $1 billion loss
article.
Yeah.
I think I might have saw it on Twitter. Someone tweeted it and sent it to me, which I think is correct. Or it was on Yahoo Finance or something.
It had a decline in deposits. I think they had to price that note a little higher than what they thought.
Yeah. So the challenge is that vicious cycle there on assets and liabilities. That's the part a lot of people don't realize. They think it's just, oh, there has to be one asset impairment and that screws the bank. No, actually it's a vicious, like the reason they call it a run on bank is because the speed and velocity which it happens, because it's both the asset and the balance sheet collapses on itself. That's your concern. For any kind of situation, which is why like seeing both a big write down plus you've got this weirdness going on from the crypto asset side, it does require that you give it you do have to kind of pause at that point before going long literally anything.
There's another local bank called First Republic Bank. I think they're in New York also, but
yeah, they are. They're
kind
great.
of a similar business model.
I actually looked through their financials very briefly for someone else early this morning. That's why I said but they're actually, I think they increased reserves. They're fine.
Okay.
It's just it's like the ones that you're going to be the most like Silicon Valley. I would have put them in line. They don't really. The only reason that I might have put them in line faster is because both their size, they just trade really strangely. But the other thing too is that some of the private equity work may have had some like crypto adjacent, let me call it, type of exposure to it, because a lot of people do use that technology and then fund themselves in a particular way that may not be truly crypto. Let me say it that way.
Oh,
but
wow.
at the same time, that bank was actually a properly run bank. So I would have thought that the downside would happen later. Maybe give me another day and let me go through the financials again.
Look at this. Peter Thiel. He was founder of Facebook, right? Peter Thiel's Founders Fund advises companies to withdraw money from Silicon Valley Bank.
Yeah.
That's major. Wow.
Yeah, I mean, a run on bank, I think it's really, honestly, I don't know why he must really have a bone to pick. To me, I think these runs on banks are nasty because the ultimate effect of a run on bank, you guys, and this is why you won't see me being too nasty on this, is because, look, at the end of it, if it actually does come to FDIC insurance, guess who pays that? The taxpayer. So it is not in our best interest for like all of the banks to require use of the FDIC insurance. It's like really uncool, quite frankly. So you will never see me saying that. However, I do think that you do want to be careful, with which banks you choose. If you're in a smaller bank, maybe go to a larger bank that definitely has clearer financial where the financial a little bit better. I will review Silicon Valley Bank in the next day or so.
Okay, here's your article. It says it lost nearly $2 billion selling assets.
Sorry, yeah.
Wow. That's a lot.
Yeah. And so that can oftentimes happen from a combination of number one, having to take a mark, but number two, people starting to freak out and pulling deposits such that you go through, once again, let me just show this little baby slide that I made. Sorry that it isn't prettier, but there's liquid stuff, non-liquid stuff that you're going to potentially take a small mark on, and then the truly non-liquid stuff, some of which could actually go below zero.
Got it.
Yeah. How much does that suck? But like for Friday, you guys. So, buckle in for sure. Let me give a shout out to everybody who's so sweet that always comes in. PB, thank you. Hopefully we got you on that. Kim, thank you for coming as per usual. Israel.
Israel's asking. That's SIVB, Silicon
Oh,
Valley Bank.
yeah. Oh, yes. SIVP. Cool. Hadouken, thank you as always for posting some good definitions for folks that come in. I think I got most of the people. And CJK, thank you for watching this and really appreciate all of you. If there's a way to help me out on Twitter, let me know because I am probably still like 15 to 20 days away from being even allowed to get a blue check mark. And so I don't want Twitter to think I'm a fake account. So I appreciate you guys for your help and support there as well. And good luck.
Twitter's been around since 2009, me. Bye.
What's that? I know. Okay, David
Twitter's going to take a
Show is
long time.
making fun of me for being behind the curve on that. That's fair enough. All right, good luck, guys. Don't lose money, and we'll talk again soon. Bye.